Hi, Professor Rex here. I recently started putting the list of dividend growth stocks that we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free if you want. This Monday on Substack, I will also post the name of a dividend growth stock we are selling this week, a consumer cyclical stock that has a total return of 59% so far. You can find the link to the Substack newsletter in the video description. Again, it's totally free to sign up for. I'm trying out Substack to see what it's like as a platform. And since I'm brand new to Substack, the newsletter is nothing fancy right now, but should get better as I learn the platform. Now in this week's video, I'm going to focus on the two dividend stock portfolios in yellow, in which we invest additional money on the first trading day of every week. They are the Dividend Growth portfolio, which was started in 2022 and now has an annual return of 15.61% and is beating the S&P 500, and our high yield stock portfolio, which has an annual return of 19.32% per year and is also beating the S&P 500. The high yield portfolio was started in 2023. On the chart this week, I've also included the benchmark for comparison. The benchmark is in blue and the portfolios are in green. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students I started last year as outlined in red, and now has an annualized return of 4.52% as tech stocks have been beaten down a lot recently. I'll also talk about two different strategies, our Wide-Moat strategy and our capital light strategy. Now the tech stock portfolio is our newest portfolio, and because it's 100% invested in tech stocks, it's our most volatile portfolio, as you can imagine. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three of these portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our Wide-Moat and capital light. I guess I already explained that. And those two are beating the S&P 500 too. As a reminder, the portfolios on the right side in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to beatthestockmarket.com to read more about those if you like less frequent trading. Later in the video, I'll also discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 107 holdings, our high yield stock portfolio has 40 holdings, and our tech stock portfolio has 25 holdings. Now this slide is showing the portfolio value over time for our original portfolio, our dividend growth stock portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,878 after 174 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stocks. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now the tan line on this chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well at all. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as our portfolio really took off in November of 2023. And for those who have been asking, all three of the portfolios are now on the website, which is beatthestockmarket.com. And as an experiment, like I said before, I'm putting the dividend growth portfolio also on Substack, and the Substack version is free. We post the stocks that we're buying in real time on Mondays when we're making our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Now, if you're new to my channel, I'm an accounting professor that teaches accounting and finance, and I often show my students how to use the accounting concepts that I teach to pick stocks, because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. Now, there are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. Now, before we get into which stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, beatthestockmarket.com, which you can see on this slide. Now, my favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on our website, beatthestockmarket.com. They are the trending value stock screen and the consumer staple stock screens, as you can see on this slide. I update the stock screens monthly. So what is a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price-to-earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like the book. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I'll try to put the links to the 2 books in the description of the video. Also check your local library to see if they have them and you can read them for free. Now, in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 19.32%, which is higher than our dividend growth portfolio, which is an annualized return of 12.54% over the same time period. I expect that the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 1% of the portfolio in tech stocks. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for 21 months, so its annual return will likely jump up or down to a greater extent than our dividend growth stock portfolio's return. And for that matter, our tech stock portfolio has an even shorter history, which is why its performance has varied the most. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Now, SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend growth classroom stock portfolio's return is 15.61% per year. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would be only 4.14%, a difference of over 11 percentage points per year. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Now, obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our 2 dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has at times had large positions of stocks I consider to be value traps. And if you are an investor in SCHD, you really need to check to see what stocks they've recently put their money into, because they've changed a lot, and not all of them are good. Now, this slide shows our best performing stocks for our original portfolio, the dividend growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. Broadcom is in first place with a 267.7% total return. Evercore Investment Bank is in second place with a 252.9% total return. Like I said before, it's been sold. The fastest risers that are still in the portfolio are Bank of New York Mellon, which has more than doubled in 18 months, Perdoceo Education, up 91% in 20 months, and Goldman Sachs, which is up over 90% in 25 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now, let's look at the strategy column. Specifically, the strategy called Dividend-Growth stocks. That is about 90%, technically 89% of our investments so far have been made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10 or 11% of investments so far have been invested in the usually smaller, under-the-radar dividend payers. These companies are companies that recently started paying a dividend for the very first time. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the stock market averages by a significant amount. This slide shows our best performing dividend-paying stocks this week for the Dividend-Growth portfolio. The best performers were Perdoceo Education, up a whopping 23.7%. Microsoft, up over 11%. Now, it's crazy that a company that big can go up that much in a week. So it was a great week for Microsoft. Monolithic Power Systems was up 9.1%, as was Meta Platforms, also called Facebook. And Taiwan Semi was up 8.6%. And then this slide shows our best performing dividend stocks for our high yield portfolio. And this is of over the last week. I forgot to change this. This too is wrong. It's over the last week. So Novo Nordisk was up 11.5% this week. AbbVie was up 6.7%. Papa John's up 6.6%. And American Tower was up 6.1%. Here's the usual disclaimer before we get into which stocks we bought last week. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now let's talk about the Dividend-Growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 stocks. And going forward, I will, like I mentioned, I'll also be posting these on our Substack newsletter, and it's free. On this slide are my 10 ratings for the top 15 dividend-paying stocks, but we only buy the top 10. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow, such as Microsoft and MasterCard, have already grown to be 4% or more of the portfolio. So we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Now remember, we use many criteria to filter stocks, and if a stock is hovering near a required level, the stock can make the list one week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecasted to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. That's why it's called a dividend growth portfolio. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly does not make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Now each week, like I said, we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we're buying the top 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and that are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we're purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock portfolio on the next few slides. Last week, I purchased over $2,800 of the stocks from the dividend growth portfolio and the high yield and the tech stock portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF, which is SCHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit as an experiment to see if I can boost returns. Of course, I'll share those results with you when I get more data. Now on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 89 to 90% of our purchases. The other 10% or so have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the stock market averages by a significant amount. Now, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidates they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but our research also dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's rarely the way it works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. So don't chase yield. Let's talk about our quality rating again. One of the components is moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they are more likely to increase their dividends even during an economic shock when compared to dividends with no moat. In this slide, Morningstar shows there are three categories of moats. On top, we have the companies with a wide moat, which are considered the best competitive advantages. This slide shows that during the 3-year COVID period, so this is when the companies were stressed at a maximum amount, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide-moat companies were able to raise their dividends despite the economic turmoil. Only 18% or so cut their dividends. For companies with no moat, which is at the bottom, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers the 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are close to retirement take my classes. They're more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into a separate Fidelity account, and those stocks have higher dividend payouts than the stocks in our dividend growth portfolio. The portfolio as a whole has an annual total return so far of 19.32%. Since the portfolio has been in existence for 21 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought all the stocks today, would be 4.43%. Compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends as fast, but the dividend yield is a lot higher in this portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Now, having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks high and reinvest into better bargains. So sell high, buy low, pushing the portfolio's yield based on the amount we've invested to 4.87%. Now, two strategies are being implemented in this portfolio, as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. Not easy to do. Now, Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 13.04% and has been held for an average of 223.8 days so far, which is an annualized return of 22.14% using Excel's rate function. Now, let's talk about the high yield dividend paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the 8 stocks. And because the high yield portfolio currently has less than 1% in tech stocks, for those that want to add some diversification to the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, which I love, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. So there's always a trade-off, and like I mentioned before, don't chase yield. Just because something has a high yield doesn't mean it's the best investment. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we purchased only 8 stocks. And we have 2 different strategies within this portfolio. Strategy 1, as I mentioned before, emphasizes a high dividend yield over dividend growth. It's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to get the best of both worlds. Now, because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split amongst the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means a stock could appear in both Strategy 1 and Strategy 2. And as you can see, Comcast appears in both this week. Now, both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing Strategy 1 are Novo Nordisk, Comcast, UPS, and Enterprise Product Partners. And then in the 4 high-yield stocks we bought last week while implementing Strategy 2, Comcast, Merck, State Street, and PNC Financial. And here's a look at last Monday's rating for competitive advantages, management, and financial health. On this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields but a greater potential for excellent future growth in those dividend yields. Now, on this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Once again, we had several dividend increases for our portfolio stocks. Companies in our dividend growth portfolio that increased their dividends since the last time we showed this slide include FactSet, Apple, American Waterworks, Atcor, Alphabet, also called Google, Ameriprise, Lithia Motors, Qualcomm, Travelers, Kinder Morgan, and Salesforce. The last 22 dividend increases for the portfolio have an average of 7.8%. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the latest quarter increased 80% over the same quarter a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main stock portfolios? The first reason is, according to a Hartford study, over the past 51 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.2% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.31%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a history of having a higher return and less volatility than non-dividend paying stocks. That second point about having less volatility is probably even more important than the fact that dividend paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend stocks only invest in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first ever dividend, called Dividend Initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million, a difference of 116.7%. And when compared to the S&P 500, which contains non-dividend paying companies and companies that do pay a dividend, the dividend growers and initiators performed 62.5% better. So not only do dividend paying stocks historically have a higher return on average than stocks that do not pay a dividend, dividend-paying stocks also historically outperform the S&P 500. They also have less volatility on average, and they tend to perform better than non-dividend-paying stocks in down markets, also called bear markets, by about 1 to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend-paying stocks hold up much better in down markets than non-dividend paying stocks on average. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travels, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. That means that quality dividend-paying stock can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which increased its dividend for the second time last year and for the 14th consecutive year. I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I'd started a dividend stock portfolio for the investment newsletter that I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents, seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you can have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, the amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invested these same stocks in my retirement portfolio, my taxable brokerage account. Now, another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per year to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. Now, for our classroom dividend-growth stock portfolio, in year 2, we boosted the weekly investment by 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower in 2024, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 each Monday. Now let's talk about ways to potentially increase the return of our dividend growth stock portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week on Monday, I post the top 15 dividend growth stocks on beatthestockmarket.com. This list is also shown earlier in the video. Of those 15, I buy 10 different dividend-paying stocks ranked 1 through 10. Of those 10 stocks, on average, the stocks in positions 1 through 5, in other words, the higher ranked ones, outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 and skipping 6 through 10 would have improved annual returns 109%, meaning double the annual return. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Now, option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Now, normally, if a stock's allocation in the dividend growth stock portfolio is 4% or greater, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio to be very diversified because the ultimate goal of dividend investing, remember, is to have the dividends cover all your expenses plus generate extra income for vacation, travels, etc. Now, I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point 1. So far, not limiting individual stocks to 4% of the portfolio would have improved annual returns by 3.6 percentage points per year. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and ReposiTrack's 97% gain in the same time frame. On average, they have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend-growers is because many of the under-the-radar dividend payers are very small companies, and small stocks have not performed as well in recent years compared to large companies. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling a stock when it's fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts the dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if the stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling it at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost the portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. Now, when I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one doesn't mind less diversification in the portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. Because we are investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that's most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you're better off using Excel to calculate it for you, and then use Quicken software to double check it, which is what we do. That's it for this week. In the comments, let me know if you have any other questions. Also, let me know what portfolios or investment strategy you would like to see more of. And finally, here are the places you can reach me: YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!